The average person in their late 20s in the United States has around $10,000 saved for retirement. How much dividend income can you expect from a portfolio of that size? While $10,000 is insufficient to sustain a typical retirement, you might be amazed at how much it could pay in dividends alone. Perhaps it would be sufficient to augment your income or cover the cost of a holiday. Examine the various scenarios that would provide variable degrees of revenue. This will give you an idea of how much money you'll need to become financially independent. Watch until the end to learn about a common investment blender and how to maximize your investments for significantly more money in the future. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. There are several investment options available that offer differing degrees of dividend income. The S&P 500 index is perhaps the most popular investment. This is popular because it gives investors access to 500 significant U.S. corporations with a track record of stability and profitability. It's well-balanced, which means you own a piece of each area and industry that makes up the stock market as a whole. Warren Buffett strongly advises investors to invest in the S&P 500, also known as the market. If you buy an ETF or index fund that tracks the S&P 500, you'll get a dividend yield of less than 1%. This is due to the fact that many of the largest holdings are technology businesses, which are notorious for paying little or no dividends. With a $10,000 investment in this index, the dividends would only be about $150 per year, or $12.50 per month. Another popular investment is the Dow Jones Industrial Average, which consists of 30 of the top corporations in the United States. Investors might buy a Dow fund and receive a dividend that is somewhat higher than the S&P 500 at just over 1.5%. To attain a greater dividend yield, consider investing in a fund that focuses on income rather than capital appreciation. There are numerous high-quality options that invest in equities of reliable companies with a long history of dividend payments. The Invesco S&P 500 High-Dividend Low-Volatility ETF, for example, has a dividend yield of roughly 4%, which is much greater than the total S&P 500. However, it exclusively invests in companies that pay the largest dividends, leading in slower long-term growth. With $10,000 invested in this fund, the annual dividend income would be approximately $400 or $33 each month. There are also additional high-dividend funds available, which are perfect for older investors looking for consistency. These funds outperform in bear markets and underperform in bull markets, offering stability as well as consistent income, making them popular among seniors. Selecting sector or industry-specific funds is another technique to generate higher-than-average payouts. These funds invest in companies that operate in a single sector or industry, such as energy, real estate, healthcare, and others. Because of the nature of their business, some industries pay out bigger dividends. Due to unpredictability from economic swings, renewable substitutes, and restrictions, the energy sector, for example, offers a relatively low-cost option with a high dividend return. The dividend yield on the Vanguard Energy ETF, for example, is more than 3%. Real estate investment trusts, REITs, are significantly riskier, but offer a greater yield due to their corporate structure, which distributes the majority of profits to shareholders as dividends. The Vanguard Real Estate ETF likewise provides a yield in excess of 3%. Investing $10,000 in Vanguard's real estate or energy ETFs would yield approximately $300 per year or $25 per month in income. Of course, buying individual stocks is another option, but many finance gurus recommend buying index funds or ETFs, especially for new investors with smaller portfolios. You can learn about market behavior, make consistent returns, and increase your portfolio without taking unnecessary risks. After completing extensive study and being willing to accept bigger risks, you may eventually decide to select particular stocks. If you do decide to buy specific equities, you should look for a track record of dividend growth. For example, the list of dividend aristocrats is a great place to start because each aristocrat has a history of increasing its dividend for 25 years in a row. AV, a dividend aristocrat, currently pays a 4.5% yield. A $10,000 investment in this company would yield around $450 in dividends per year or $37 per month, as well as potential capital appreciation or depreciation based on future stock movement. It's a good idea to filter these prospects based on their fundamentals, making sure they have respectable payout ratios of 50 to 60% or less, positive earnings, and a variety of other prospective measures. Individual stocks are frequently sold off as a result of recent unfavorable news, earnings disappointments, or management changes. Because the stock market has a tendency to overreact, this could present an opportunity. A wise investor must evaluate the gravity of the news and make their own conclusion about the stock price. Because most investors with $10,000 are decades away from retirement, they might consider foregoing income entirely. Why? Because investing in growth stocks has the potential to generate significantly more money over time. Dividend-paying investments have historically produced lower overall returns. Young people should normally strive for advancement. A 2% difference in your annual rate of return might mean a lot over the course of a career. For example, someone who invests $10,000 once at the age of 25 and earns an 8% return until the age of 65 will have $217,000. If they had achieved a 10% return, they would have $452,000, or more than double their money by the age of 65. It's important to remember that growth stocks can be more volatile at times, which can be difficult for investors who are new to market swings. An ETF, such as Vanguard's Growth ETF, or VEG, is an excellent choice for younger investors. As the name implies, it invests in large-cap growth firms such as Apple, Amazon, Home Depot, and other well-known names. Over the long term, a growth index is likely to outperform the S&P 500, which is great for someone who has many years until they require income. VEG's dividend yield is less than 0%. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?